Welcome to the Strategic Investor Productions channel. We are a new channel, so liking the video and subscribing goes a long way to supporting the channel, and we appreciate that a lot. In this video, we will be going out for an afternoon of milkshakes on the DXY chart. With that, let's get her done. Alright, let's start off by looking at the long-term trend. You can see this chart goes all the way back to 1985, so we will use all the data we have available to us. That anchor point we have in 1985 at $128 was the top of that move, so the lines are accurate in that sense. You can see we have been in a descending channel ever since the devaluation of the dollar with the Plaza Accord. The supply line of this pattern today would put the top of the channel at about $110. While we have only reached the top of this trend twice in the last 40 years or more, both times have been periods of extreme discomfort in the economy. So, we could actually get to that point a lot quicker. We also have a nice support line that dissects the channel and has been a lot of price action for decades. I find it to be a very useful line to pay attention to. As you can see, this was a point of breakout, and then also we got stopped out at this line several times more recently. Alright, let's take a look at the medium trend. The long-term trend will be the blue lines, and the medium-term trend will be the yellow lines. You can see from this chart that after the 2008 Great Recession, we had a bottoming formation that made a pennant that ended up screaming higher on its breakout. This move started consolidating in 2015 and ended up forming another pattern. This next pattern can be called two different things depending on how it plays out. It can represent a reversal pattern, which is called a diamond reversal, or it can represent a half stav pattern that represents a continuation. I don't remember the exact probabilities of each scenario playing out, and I can't find that information readily, but I do know the diamond reversal is more likely to a degree that is statistically significant. I personally thought we were going to get a rip higher out of this due to the situation we were in at the time, but the government and Federal Reserve came in and adjusted policies to avoid it. One of the policies they adjusted was the supplemental leverage ratio, which they exempted treasuries and bank reserves from, which we will talk more about shortly. Alright, let's take a look at the short-term trend now. You can see that we started bottoming on the DXY in December of 2020. It then pulled back to test support before continuing higher. This did make a higher low on the move. This is where we formed our 1, 2, 3 bottoming pattern that played out. So in this situation, you could see we had a bottoming in the dollar. We pulled back for 0.1, and then we had a pullback there for 0.2, and then at that point, it's trying to get back from where we fell from and break out there to confirm a reversal, which would be the third point right up here, which we did break out. This most recent pullback in the dollar was just a retest of the breakout. I believe that the dollar will continue getting stronger as yields continue to increase. The delta in treasury yields will impact the magnitude of the move in the dollar. This is a chart of 2-year treasury yields. You can see that there is a long-term trend that signals times of pressure. The line is descending because of the unproductive leverage that builds in the system as time goes on in a system like the one that we have. We still have a little room to go before we hit that trend line. This is a chart of 10-year treasury yields. You can see that the same concept can be applied to the long end of the curve, although I think it's more important to watch the short end given the situations we find ourselves in today. You can see the times yields have reached the trend line where all major crises in history. In 2018, it touched as the SLR was being implemented, which was the impetus to the crisis that we find ourselves in today. It also happened in 2007 as the global financial crisis was unfolding. And it also happened in 2000 as the dot-com era came to a grinding halt. Alright, let's take all this information we just looked at and start fitting the pieces of the puzzle together. Both the dollar and treasury yields seem to be in a bullish trend, at least for the near term. The delta of yields can be a problem if it gets too large, and that would incentivize a strong dollar. The short end of the curve is going to be the most important to watch, as that's where the Fed will likely focus its taper to start. So, as of today, yields are rising at high deltas on the short end of the curve as Fed tapers, and depository institutions can't do anything to help due to their total leverage exposure, thus providing a strong demand for US dollars. The supplemental leverage ratio exemptions are expired, and credit is a lot tighter than it was in 2020. There is more stimulus talks, which means more deposits and reserves on the way in the near future. More reserves means more leverage exposure for depository institutions, which means less and less ability to absorb both an increase in deposits in the form of reserves and the ability to participate in the purchasing of treasuries themselves. This is going to continue being a tailwind for yields, and thus a tailwind to the dollar in the near future. In my opinion, this is going to be breaking at some point soon, and there are going to be policy adjustments that are unpredictable. Something like the situation in March, where they exempted reserves and treasuries from the SLR. Something like this would be a whole new regime for fixed income and foreign exchange. Thus, I don't feel comfortable supporting the idea of a strong dollar for long periods of time. But, for the time being, I call up Mr. Johnson the Milkman, because I'm looking for a dollar milkshake, baby. Share this video with someone you think would find this information useful. Like this video and subscribe to our channel with the bell icon to receive notifications when we post content like this. Alright everyone, until next time, stay one move ahead. Have a great weekend.